When selecting securities for an investment portfolio, there are several factors that we need to take into consideration. Today, I am going to discuss the determinants of required rates of return. When investing, the investor would expect a rate of return that will compensate him for the time value of money, the expected rate of inflation, and the risks involved. The time value of money is a financial concept that basically says money at hand today is worth more than the same amount of money in the future. Simply put, 1 peso today is far more valuable than 1 peso in the future. This is due to the potential that the current money has to earn more money. This is an important concept to understand finance. Suffice to say, the amount of money that you make is not the only thing that matters. It matters if money is received today or in the future. The time value of money can work for you or against you. For example, if you are deciding between buying a new phone worth 10,000 pesos or invest in a stock, for example, that yields 10% per year. If you buy the phone, you have just incurred an opportunity cost of 10%. We also consider the expected rate of inflation. Inflation is a sustained rise in overall price levels. Moderate inflation is associated with economic growth, while high inflation can signal an overheated economy. As an economy grows, businesses and consumers spend more money on goods and services. In the growth stage of an economic cycle, demand typically outstrips the supply of goods and producers can raise their prices. As a result, the rate of inflation increases. If economic growth accelerates very rapidly, demand grows even faster, and producers raise prices continually. An upward price spiral, sometimes called runaway inflation or hyperinflation, can result. In general, when economic growth begins to slow, demand eases, and the supply of goods increases relative to the demand. At this point, the rate of inflation usually drops. Such a period of falling inflation is known as disinflation. Inflation poses a stealth threat to investors because it removes real savings and investment returns. Most investors aim to increase their long-term purchasing power. Inflation puts this goal at risk because investment returns must first keep up with the rate of inflation in order to increase real purchasing power. With this in mind, investors should try to buy investment products with returns that are equal to or greater than inflation. For example, if X stock returned 5% and inflation was 6%, then the real return on investment would be negative 1%. Every economy may have inflation, which is alright up to a considerable percent, but exceeding inflation is not good for the economy. At the time of calculating expected rates of return, we must consider inflation. The higher the inflation, the higher the required rates of return. It is a central bank and government responsibility to adopt an effective economic policy by which an accepted rate of inflation can be there for an economy. The investment selection process is influenced by the required rate of inflation. Lastly, the risks involved. There is nothing where risk is not involved, and it is money we talk about is more sensitive towards risks. Risk can vary from industry to industry, company to company, and person to person. But the common thing is the higher the risk, higher the rates of return person expect from an investment. Although you may find there is a variation of risk-taking behavior among the individuals, which is influenced by the personal trait of that individual. All investments involve some degree of risk. In finance, risk refers to the degree of uncertainty and or potential financial loss inherent in an investment decision. In general, an investment risks rise. Investors seek higher returns to compensate themselves for taking such risks. The summation of these three components is called the required rate of return. This is the minimum rate of return that you should accept for an investment to compensate you for deferring consumption. Because of the importance of the required rate of return to the total investment selection process, we will learn more about these three components and what influences each of them. The required rate of return is the minimum rate of return that you should accept from an investment to compensate you for deferring consumption. The analysis and estimation of the required rate of return are complicated by the behavior of market rates over time. First, a wide range of rates is available for alternative investments at any time. Second, the rates of return on specific assets change dramatically over time. Third, the difference between the rates available, that is, the spread, on different assets changes over time. Because differences in yields result from the riskiness of each investment, one must understand the risk factors that affect the required rates of return and include them in the assessment of investment opportunities. Because the required returns of all investment changes over time, and because large differences separate individual investments, one needs to be aware of the several components that determine the required rate of return, starting with the risk-free rate. The real risk-free rate, or RRFR, is the basic interest rate, assuming no inflation and no uncertainty about future flows. An investor in an inflation-free economy who knew with certainty what cash flows he would receive at what time would demand the real risk-free rate on an investment. This is also called pure time value of money. This RRFR of interest is the price charged for the risk-free exchange between current goods and future goods. Two factors, one subjective and one objective, influence this exchange price. The subjective factor is the time preference of individuals for the consumption of income. Some want to spend soon. When individuals give up 10,000 pesos of consumption this year, how much do you think would they want from now to compensate for that sacrifice? The strength of the human desire for current consumption influences the rate of compensation required. Time preferences are not the same for everyone, and the market creates a composite rate that includes the preferences of all investors. This composite rate changes gradually over time because it is influenced by all the investors in the economy, whose changes in preferences may offset one another. The objective factor that influences the real risk-free rate is the set of investment opportunities available in the economy. The investment opportunities available are determined in turn by the long-run real growth rate of the economy. A rapidly growing economy produces more and better opportunities to invest funds and experience positive rates of return. A change in the economy's long-run real growth rate causes a change in all investment opportunities and a change in the required rates of return on all investments. Just as investors supplying capital should demand a higher rate of return when growth is higher, those looking to borrow funds to invest should be willing and able to pay a higher rate of return to use the funds for investment because of the higher growth rate and better opportunities. Therefore, a positive relationship exists between the real growth rate in the economy and the real risk-free rate. Before we discuss the factors influencing the nominal risk-free rate, it would be important to see the difference between real and nominal risk-free rates. A real interest rate is an interest rate that has been adjusted to remove the effects of inflation to reflect the real cost of funds to the borrower and the real yield to the lender or to an investor. A nominal interest rate, on the other hand, refers to the interest rate before taking inflation into account. The nominal rate of interest on a default-free investment is not stable in the long run or the short run, even though the underlying determinants of the real risk-free rate are quite stable. The two factors that influence the nominal risk-free rate are: number one, the relative ease or tightness in the capital markets, and number two, the expected rate of inflation. The cost of funds at any time, or the interest rate, is the price that equates the current supply and demand for capital. Beyond this long-run equilibrium, change in the relative ease or tightness in the capital market is a short-run phenomenon caused by a temporary disequilibrium in the supply and demand of capital. The expected inflation rate is also influential because if investors expect the price level to increase during the investment period, they would require the rate of return to include compensation for the expected rate of inflation. Risk premium refers to the difference between the expected return on a portfolio or investment and the certain return on a risk-free security or portfolio. It is the additional return that an investor requires to hold a risky asset rather than one that is risk-free. Underlying the term risk premium is the idea that there should be a higher expected return, a premium for bearing risk. Many experts claim that there is no reason why some type of premium should be associated with all types of risk. In other words, a risk premium is the expected excess return on an investment, where the excess return is the difference between the return of a risk-free security and an actual return. An investor typically is not completely certain of the income to be received or when it will be received. Most investors require higher rates of return on investments if they perceive that there is any uncertainty about the expected rate of return. This increase in the required rate of return over the nominal risk-free rate is the risk premium. Although the required risk premium represents a composite of all uncertainties, it is possible to consider several fundamental sources of uncertainty. There can be many different types of risks that bring about uncertainty in investments. The major sources of uncertainty are business risk, financial risk, liquidity risk, exchange risk, and country or political risk. Business risk is the uncertainty of income flows caused by the nature of a firm's business. The less certain the income flows of the firm, the less certain the income flows to the investor. Therefore, the investor will demand a risk premium that is based on the uncertainty caused by the basic business of the firm. For example, a retail food company would typically experience stable sales and earnings growth over time, and would have low business risk compared to a firm in the auto or airline industry where sales and earnings fluctuate substantially over the business cycle, implying high business risk. The COVID-19 pandemic has caused a lot of losses for many businesses in different industries. The pandemic knocked off around 12 billion pesos from Jollibee in the first half of 2020. It even caused Jollibee to close 200 plus stores after suffering this much. Philippine Airlines, on the other hand, reported a loss amounting to 183 million US dollars during the first quarter of 2020. Financial risk refers to the uncertainty introduced by the method by which the firm finances its investments. If a firm uses only common stock to finance investments, it incurs only business risk. If a firm borrows to finance investments, it must pay fixed financing charges in the form of interest to creditors prior to providing income to the common stockholders. So, the uncertainty of returns to the equity investor increases. This increase in uncertainty because of fixed cost financing is called financial risk or financial leverage, and it causes an increase in the stock's risk premium. Financial risks are becoming more pronounced in this volatile world economy. It's keeping economists and companies on their toes as they upgrade their risk management techniques and practices. Liquidity risk refers to the uncertainty introduced by the secondary market for an investment. When an investor acquires an asset, he expects that the investment will mature or that it will be saleable to someone else. In either case, the investor expects to be able to convert the security into cash and use the proceeds for current consumption or other investments. The more difficult it is to make their conversion to cash, the greater the liquidity risk. In the simplest terms, liquidity risk refers to the risk that an investment won't have an active buyer or seller when you are ready to make a transaction. If you are selling, this means you will be stuck holding the investment at a time when you need cash. To compensate for liquidity risk, investors often demand a higher rate of return on money invested. That is, a small business cannot be easily sold in most cases, so investors are likely to demand a higher rate of return for investing in shares than they would normally ask when we talk about highly liquid blue chip stocks. COVID-19 pandemic poses unprecedented health, economic, and financial stability challenges. Following the outbreak, the prices of risk assets collapsed and market volatility spiked, while expectations of widespread defaults led to a surge in borrowing costs. Several factors amplified asset price moves. Previously overstretched asset valuations, pressures to unwind leverage trades, dealers' balance sheet constraints, and a deterioration in market liquidity. Emerging market economies experienced the sharpest reversal of portfolio flows on record. As a result, financial conditions tightened at an unprecedented speed. Decisive monetary, financial, and fiscal policy actions aimed at containing the fallout from the pandemic managed to stabilize investor sentiment in late March to early April, with markets cutting back some of their losses. Another major source of uncertainty is exchange rate risk. This refers to the possibility that the value of an investment will change when the currency is exchanged. This occurs when there is movement in the exchange rate between placing an order and the transaction being completed. Exchange rate risk is associated with all foreign investments. A U.S. investor who buys South Korean stock denominated in won must consider not only the uncertainty of the return in won, but also any change in the exchange value of the won relative to the US dollar. That is, in addition to the foreign firm's business and financial risk and the security's liquidity risk, the investor must consider the additional uncertainty of the return on this South Korean stock when it is converted from won to US dollars. Another major source of uncertainty is country risk. Country risk is also called political risk. This is the uncertainty of returns caused by the possibility of a major change in the political or economic environment of a country. International investing is a powerful way to diversify and grow a portfolio. However, there is often a higher level of risk than in domestic investing. Many of these risks are unique to international investing and can be caused by conflicts, unrest, changes in international policies between countries, and internal politics. Political risk is among the most important factors facing international investors. In many emerging and frontier markets, the political situation is affected by more than influences within the country being considered. Political risks are risks associated with changes that occur within a country's policies, business laws, or investment regulations. Other influential factors include international relationships and any other situation which may have an influence on the economy of a given country. For example, in August 2018, President Trump signed a bill expanding the scope and powers of the Committee on Foreign Investment in the United States. The new law has important implications for Chinese investments in the U.S. market and may complicate capital flows between two countries already engaged in a trade war. Risk can be broadly categorized into two. One is systematic and the other is unsystematic, or systematic and specific risk. The returns on investments such as shares, bonds, and real estate will be affected by general economic conditions. Returns will also be affected by issues that are specific to that particular investment. These two types of risk are called systematic risk and specific risk, respectively. Systematic risk is risk directly involved with the system, which arises from the macroeconomic factors, and it is not possible to minimize this type of risk through diversification of investment. The risk created by general economic conditions is known as systematic or market risk because the risk stems from the wider economic system. For example, if the economy enters a recession, many companies will see a downturn in their revenues and profits. The other category of risk is specific risk. Risk that is specific to a certain company or security is variously known as specific, idiosyncratic, non-systematic, or unsystematic risk. Unsystematic risk is a type of risk that is possible to minimize through diversification of investment. With this risk, there is a correlation between risk and diversification. Example, the share price response when a company launches a successful new product, for example, the Apple iPad, or the response to the negative news that a promising new drug has failed in trials.